What's going on YouTube? It's Gannon Mo and welcome back to our channel. Today we're going to be continuing part 2 of our Q&A series. So stay tuned, gingerly hit that like button and let's get started.
So in our last video, we covered the top 5 questions that we got asked throughout the weeks of creating this YouTube channel. So in today's video, we're going to cover another 5. So let's start with number 6.
How can I start investing?
So you can start investing with as little as $1. We discussed that during the last video. Now, there's different ways to invest and there's different means for it. So the most basic ones are an interest-bearing savings account. And as we discussed, that's going to give you between 1.55% and 1.8%. And of course, the more risk that you take on, the higher investment return that you're going to be making. Another one is stocks or bonds. Now, what a stock is that you're buying a portion of that company. Now, it could be a very big company, but nonetheless, you're still an owner of that company. Or you can purchase into bonds. That's whenever a company borrows money and they're paying an interest rate on that money. So if you own a bond of a company, you own a portion of the loan that is given to that company. Another way that we personally recommend is buying a full index, almost like a little basket of different stocks. So what that basket includes is a full plethora of different companies, and you're going to be owning a portion of that basket. So why we recommend that is because you're able to diversify your risk on your investment. And typically when it comes to different stocks or buying into different ETFs, your average return with dividends included and adjusted for inflation is going to be between 8 to 10%. Now, whenever you're buying into the bond market, your average return is between 4 to 5%.
But the main question alongside of that is, okay, I want to start buying stocks, bonds, whatever the case is, where do I even go buy them? Well, I'm sure you've heard of the names Vanguard and Fidelity, Charles Schwab. You can go online, open up a brokerage account and start buying those stocks and bonds through there. And you can do a lot of research, but for instance, if you want to buy into the S&P, which is what we do, you can do that through Vanguard, Fidelity, or Charles Schwab, and both of them have their own sticker price, and basically that's how you end up buying stocks.
Another way is you can actually download different investment apps such as Robinhood or Webull, and those different apps are going to be allowing you to buy into them, and the good thing is that they are not charging per commission. Our last investment, we can call it real estate. Now, real estate comes with a lot of different things that you have to consider. But the main point of investing in real estate is for that cash flow. So whenever we're talking about cash flow, is that what we're saying is you pay all the expenses on the property, including any mortgage that you're carrying on that property, and the money left over after you cover repairs or vacancies is the cash flow that you get to keep. And that is the equivalent of having dividends from a stock.
So what happens if you don't want to get fully involved into real estate, but yet you do want to start investing in some real estate? Well, you could start using crowdfunding platforms. These are platforms designed for real estate, but you don't have to purchase the whole property. You're basically part of a team that's purchasing a real estate. And these can be as low as $500 on the initial purchase of the real estate for the fund, and the returns are usually 8 to 15%. Now, of course, you have to always do your due diligence just as you do in any investing opportunity. But this is just another way for you to just say, look, I want to get involved in some real estate, but I don't have 20% down to put right now, and I don't have all cash. And this is just a great way to kind of diversify your portfolio as well.
Another thing is REITs, which is pretty much just a collection of different properties and different things that are almost traded on the same exchange as stocks.
Let's move on to question number 7.
Is investing safe?
So anytime somebody mentions the word investing, they think that investing is gambling. That's very, very common when it comes to our family members. My aunt, my dad, my mom, everybody, whenever I say I'm investing, they're like, please don't lose your money. Guys, investing is not losing your money. If you know what you're doing and you know what you're investing into, it's not gambling. It's not like you're buying lottery tickets. Investing is just a term that we use to explain how we're going to be putting our money to get a return on that money. But of course, it doesn't come without risk. Now, the more risk that you take, the higher the possibility of the return that you're going to be making, as I discussed previously. But overall, investing is not something that has to be coming and associated with gambling.
Now, when you're investing, you're going to go through periods of emotion and you're going to go through periods of disappointment. And the important thing is during your investing is to stay the course. There's going to be times where you're losing money in your portfolio. You're going to see negative $2,000, negative $3,000. You're going to see a lot of red and you want to see a lot of green. We all like green. Green is money. But you have to remember, you are only losing money if you sell out. That number in your portfolio is just a number on paper. But if you actually start selling during your investment period, you're actually going to be losing that money if you're in the red. So obviously we always say, and I know we sound like a broken record, stay the course and invest financially and not emotionally. Sorry for that. But that is true statement of investing. Let's move on to question number 8.
What is a better investment, stocks or real estate?
I don't want to get into which one is better because better is a very relative term. So let's kind of go into the facts and let's decide together. When it comes to a balanced investment plan, you have to have different elements in it. So what does that mean? It means that your whole entire portfolio, so let's say most portfolio and Gannon's portfolio, it cannot be 100% real estate. It cannot be 100% stocks. So a well-balanced portfolio that's considered diversified, it means that you are investing into different things. So let's say that you have a balanced portfolio and that to you, you're at the age of 30, 35, 40. So typically a portion of that, let's say 50%, that's going to be going into different retirement accounts and different brokerage accounts, is going to be tilted towards 90% stock, 10% bonds. If you are less risk averse, you're going to be going into maybe 50 to 80%. And if you have no risk tolerance whatsoever, you're going to be going between at 90% bond, 10% stock. And that all encompasses about 50% of your portfolio. Now, the other portion of your portfolio, the other 50%, can be divided into different segments. So you can have 40% real estate and 10% alternative investments. So what is alternative investment? That includes all the different fun stuff that you guys hear about all the time, like the Bitcoins and like lending private money to people, or it could include owning a different business, or it could include just something random that you're just into investing in. Your fund money. So let's say your fund money is 10% of your entire MoGAM portfolio. The other 40% is real estate. And real estate could be divided into different things. Let's say you want to buy into notes. Let's say you want to do some hard money lending in real estate secured by an actual property. You want to jump into crowdfunding. You want to buy single family homes. You want to buy apartment buildings. You want to buy multifamily properties. Now that's up to you guys. And the returns are going to be dependent on your risk level. But typically, if you are able to cash flow a property, you can typically expect between a 10 to 12% return on that real estate portfolio.
So everybody always asks, how do I know my risk tolerance? Well, that's up to you. What is your risk tolerance? How risky are you in the investing world? So the younger you are, you tend to be a little bit more aggressive. So we're young, relatively. So we tend to be a little bit more aggressive. So for me, for instance, I'm about 100% into stocks. I have no bonds until recently where I started buying just a couple bonds with just how everything was going in market volatility. And I know Mo's pretty aggressive in buying real estate and buying stocks. So the older you get and the closer you get to retirement, you really want to kind of hinder in on the conservative aspect and stop being so aggressive. So you might start deviating your portfolio into 70% stocks, 30% bonds, 40% real estate, and so on and so forth. And you just kind of adjust your portfolio based on that risk tolerance and also when do you want to retire.
So in my particular case, I'm going to give you guys a general idea of how I invest and how I direct my money. I gave you guys what a balanced portfolio would look like, but in my case, it's typically about 60% real estate, about 30%, actually 20%-ish that goes into the stock market. And I typically do 100% stocks, 0% bonds for now because of my age. And then for the remaining 20%, I typically invested or reinvested back into my business. Question number 9.
Should I go into more debt and go into professional school?
That is a question based on you and you only can answer that. We can give you our honest opinion. So going into professional school is a lot of work, a lot of stress, exams, board exams, studying, homework, and it is an awesome experience and yet a very stressful experience. Now, I went into professional school knowing I would go into debt. Mo went into professional school, Mo's wife, my fiance, everyone went into professional school knowing that it's going to cost a lot of money, but I think everybody right now can agree it was damn well worth it. The opportunities you get, these job security you get, especially in the healthcare industry, there's a lot of job security. So yes, the debt is there. Yes, you're going to be like, oh God, now I have student loans to pay for. But just a side note, student loan debt is not the same thing as credit card debt, a car debt. It's a true investment in yourself. So say your education is going to cost you $300,000. You're investing $300,000 into yourself. And investing in yourself, yes, you can read books, you can do that all day, and that's a great investment that's cheap, and obviously you're gaining a lot of knowledge from. But going to professional school and accruing that student loan debt is an investment in yourself. And when you pay that off, you've actually become that much more wealthier. So in my opinion, yes, going to professional school was worth it.
So yes, investing in yourself is always going to be paying off, and it's always going to be the best return on the money. But you have to do it within particular terms. You have to make sure that you're not taking too much debt for the amount of income that you're going to be making. What do I mean by that? You are not going to be okay if you take out $500,000 in debt and your income is going to be $50,000. It all has like little parameters. So in my parameters, 1 to 1.15 on what that debt to income level are going to be. So what do I mean by that? I mean that your income has to be, let's say, $100,000 for a debt level of $150,000. Otherwise, the numbers are not going to work out in your favor, and you're going to be in debt for the rest of your life. So please factor those in. Make sure that you ask a lot of questions. There is no shame in going to other doctors or other professionals in the field that you're thinking about going into and asking them what to expect regarding an income, and then look at how much that schooling is going to cost you before you make that decision. Question number 10.
Last and final.
How often do you guys work out?
We typically work out about 4 to 6 days a week, a couple days for cardio here and there, a couple days with the weights, and it's just something that we do just to keep us healthy, keep us engaged. It's just a passion of ours. We've been doing this for a very long time, and we recommend the same for you guys.
Financial fitness is what that's called, and no, we do not work out together. Not everything we do is together. So we hope you guys enjoyed this 2-part series. 10 questions total, 9 educational questions, and 1 awesome question. So you guys know that drill. Gingerly tap that like button, press that red button, subscribe, and that bell, and we'll see you next time.